welcome to the Capital Employed podcast. For this episode, we had the pleasure of welcoming back to the show Theron de Ris, who is the founder and manager of Eschler Asset Management based in London. If you want to know more about Theron's investment style, then I would suggest listening to episode 15 where he talks about this in more detail. For this episode, Theron discusses how his fund has performed so far this year, why he's still bullish on gold, and 2 stocks he's recently added to the portfolio. This is a short but very sweet episode, and I think you will really enjoy it. Before we begin, every so often we will be doing write-ups about stocks from around the world that have piqued our interest. These will mostly be companies on the smaller end of the market cap scale that go under the radar of most financial media. So if that sounds like your cup of tea, visit capitalemployed.substack.com and add your email to the list. That's capitalemployed.substack.com. Please enjoy my conversation with Theron. Hi Theron, welcome back to the podcast.
Thanks, John. It's great to be here.
So how has 2022 been for your fund so far?
Well, we've had a good start to the year. We're up probably about 8 or 9%. We tend to invest in industries, geographies that have kind of suffered a major dislocation. And so, we loaded up on energy related shares in 2020, post the pandemic. They've of course gotten a recent boost. And then we've also had a long-standing holding in precious metals related securities. They were pretty out of favor last year, actually, with the broader market up 25 to 30%. They actually sold off. And so the second half of last year, we were adding somewhat to our position there. And that's started to pay off this year as there's been demand for safe haven. So we're doing well.
The last time you were on the podcast back in April last year, you were very wary about inflation. How are you viewing inflation now, and how are you positioning your portfolio to deal with it?
Yeah, it's fair to say we've been positioned for inflation for the better part of 10 years, actually. We've tended to be invested in stocks in resource areas, energy, financial, more cyclical areas of the market. That's where we perceived value. And these were areas that tend to benefit from inflation and were cheap. And in the case of resources and energy, have a generally lower correlation with the broader stock market. We've had that positioning for a long time. And, I think 2 years ago when the pandemic hit and the fiscal spending spigots were opened up, that was really kind of the trigger for, all this money printing that until then had been trapped in the financial markets to really hit the real economy. More recently, this war that broke out tragically it's not the cause of inflation, despite what President Biden might tell you. Our main task right now, John, is to basically sit tight and not trade out of our positions too early, frankly. Maybe I'm not too popular with our brokers right now. We're not doing that much. But because we had the right positioning, we're trying to take advantage as much as we can.
So you're still expecting inflation to stay reasonably high for the next year or so?
Certainly, yeah, higher than the average of the past 10 years. If anything, very high in the next several months still. Our largest position continues to be gold and silver related securities. I'm sure you've seen gold hit an all-time high just last week. I think this move to freeze Russia's central bank reserves is just a tectonic shift. It's a real green light for foreign central banks and others to diversify away from the dollar. Frankly, I think it's also a way for the U.S. to kind of tell the world that it wants a weaker U.S. dollar, and that's because the U.S. dollar has sort of been the medium through which the petrodollar revenues have been recycled, and that's kept the dollar strong for many years. And strong dollar is not necessarily in the interest of the U.S. right now, right? Because it makes China more competitive, and it kind of helps to deindustrialize America. And what America really needs now is to rebuild its industrial base, to have, frankly, high inflation, high wage inflation, to sort of reduce inequality and get real wage growth up, and also to inflate away the debt. So I think there's an interest on the part of the U.S. to have potentially a weaker dollar, and that plays into the hands of gold.
Before we talk about maybe some of the new stocks in your portfolio, last time you were on the podcast, you discussed EMX Royalty and Penza Investment Management. Are you still holding those companies, and how have they performed over this past year?
We've actually sold out of both of them. As value investors, a stock can be cheap at one price and fairly valued at another, and so that entails some level of turnover, and the investment thesis can also change, or you can find something better. And that's what happened in the case of EMX Royalty. We held the shares for 2020 and most of 2021, but some of the catalysts that we've been expecting kind of got pushed out, and because we purchased it at just over a dollar a share, and it had gone up to nearly $3, we sold out essentially, and some of the catalysts we'd been expecting had occurred and others were pushed out. In the case of Eschler Asset Management, it's quite simple. In the summer of 2020, when value shares were really on their back, we bought it at like 5 times trailing earnings, right, on the expectation that it would trade up substantially to a more historically normal 10 times earnings, and that's really what happened 18 months later. And so we basically bought it at 5 and sold it at 10. It's just kind of as simple as that.
That's great. So can you talk about maybe 2 new stocks in your portfolio that you are very bullish on? What was your thesis for investing?
2 stocks. The first one is Agnico Eagle, which is a senior gold miner. And the second one is ANIM, SGR, which is an Italy-based asset manager. So the first is Agnico Eagle. Look, this is actually a $28 billion market cap company. Trades around $61 a share, and recently purchased it. And basically, I like it for 3 reasons. The first, it has great assets. The second, has a management with a very strong track record. And the third is it has quite an attractive valuation. And there's also a reasonably interesting set of catalysts. So just first, in terms of the asset base, this company recently underwent a merger of equals with Kirkland Lake Gold, which brought it a very high margin mine in Australia, but more importantly, brought it Detour Lake, which is one of the largest gold finds in the last decades in Canada. So the new combined company has by far the best assets in the best jurisdictions of all the larger gold miners. Its average reserve grade is 2 times higher than its second best peer. So the asset base is very attractive, especially with this backdrop where jurisdiction risk is very real. Second, on management, the company has a very strong track record of capital allocation, with success both in acquisitions, organic investment, dividend consistency, and also buybacks. Yeah, I think it's just a superior way to own gold, but it does come with a lot of volatility, so you do have to kind of pick your spots. But it's a company that over 25 years has produced a 13% total return per annum, which for a gold stock, as you can imagine, puts it right at the top. And then the third reason is the valuation. This is never a statistically cheap stock, but right now I think it's reasonably attractive because its historical premium relative to the other large gold miners has disappeared, and that's despite it having these much better assets in much better jurisdictions. And I mean, just one simple way of describing the opportunity is that the shares are still 30% off their highs, reached in the late summer of 2020, and that's despite gold being back at its highs. So you would think that there's an opportunity for Agnico Eagle to have some catch up, and that applies to the entire gold sector. And if you look at price to book or price to sales multiples, the averages over longer periods of time, again, there's a reasonable case to be made that the shares, which are now at 60, 61, could trade in the $80 to $100 range. In terms of catalysts, the first quarter here should be the sort of the trough They have some COVID-related interruptions that have lasted into the beginning part of this year. So results should get better through the year. You have very substantial merger synergies that will come through in coming years. Very conservative forecast, and a lot of free cash flow because they've made a lot of investments in the past several years that are now going to start paying off. So I really think this will become the go-to institutional gold stock. Shall I move on to the second one?
Yeah, please do.
Okay, very briefly, ANIMA, ticker is ANIM in Milan. It's a $1.3 billion market cap and trades around 360, 370 euros per share. And again, here it's sort of a combination of macro and micro, which tends to be a feature of our investment thesis for a stock. So first, it's the leading institutional asset manager in Italy. They do institutional and retail, but are geared a little bit more towards institutional and have outstanding distribution throughout the country. So you walk into most banks in Italy and you have access to ANIMA's products. And just in terms of the investment thesis, first, Italy is very oversold now. In the past couple of weeks, the stock market there is down 20 to 30%. So Italy is very oversold in the short term. The second is, the Italian economy is actually very strong. I mean, last year it was one of the best economies in the developed world, and you have leadership under Mario Draghi, which has been assured for another year before they have elections, and he is helping to implement a number of reforms that open up funds from the European Recovery Fund, grants and loans. So there's real economic tailwind for Italy, which should feed through to general economic activity and liquidity for investors to deploy into products that Anima sells. And the third reason is Anima is very cheap. I mean, we actually purchased the shares just a couple of weeks ago. It was under 5 times trailing price earnings ratio. The dividend yield right now is about 9%. The company is buying back stock. They've bought back about 0.75%. So nearly 1% of their shares outstanding just in the past couple of weeks since the war broke out. So there's a reasonably simple opportunity here for the shares to revert back to an average multiple, and an average is extremely low. So in the past 2 years, the PE has averaged eight times, right? So that would take the shares into the 550 or so per share, up about 50%. Since they listed in 2015, they've traded at on average of 13 times PE. So there's a lot more longer term upside. Italy is very oversold and historically cheap. I think this is a reasonable way to play a reversion to the mean. So that's Anima.
I agree with you about Italy being a very good value at the moment. I have 2 shares in my own portfolio that are Italian companies.
Oh, really?
Yeah, good place to be, I think, over the long run.
Yeah.
Yeah. Okay, that's great. Okay, so if you could go back in time when you first started investing and managing money professionally, what advice would you give yourself? Is there anything you would do differently?
2 things. I mean, the first is, if possible, I would try and start in business with a partner to sort of share the burden. Now, I don't mean like a co-portfolio manager, because I don't think that works very well. But had I started with a partner who was focused on the non-investment related activities that a startup needs to get right, we may have had an opportunity to gain critical mass faster. So that's I think that can make a lot of sense than to try and go it alone. In hindsight, of course. And then the second thing is risk management. I would probably try and have a better framework around risk management. That goes beyond just sort of the toolkit of the value investor, which says, I'm going to purchase a stock at much less than what I think it's worth, and I'm going to have a portfolio of these opportunities, and that's my risk management. there's actually a lot more that goes into that, and I think it takes experience, unfortunately, to perhaps put this risk management framework together. But ideally, I would have had more of a program around position sizing, liquidity management, correlation, basis risk, these types of things, exposure, etc. When I first started out. But again, it takes some time in the market to perhaps refine a risk management approach.
Okay, so where can listeners go to find out more information about you and Eschler Asset Management?
Sure. So we have a website, www.eschlerasset.com. And you can also ask to join our mailing list from the website. We send out periodic updates. So we just published a white paper describing some of our investments in resource areas over the recent cycle, how we implemented them, how we measure our results, and some of the outlook that we have. We also have a number of videos on YouTube on our channel. You just type in Eschler Asset Management. We've appeared on several conferences and interviews and whatnot. And we have a small office here in London as well. If anyone wants to visit us, we're always interested in meeting people.
That's fantastic. Okay, Theron, thanks so much for coming onto the podcast. It's always a pleasure to listen to you.
Thanks, John. Again, I appreciate the opportunity.